just got to have a strategy that works and what the market's doing. I think that one of the advantages that I believe in is that we can't decide what it's going to do, but we got to have a strategy that will work no matter what it does,
Mm-hmm. That's right. Well, yeah, no, that's there's so much uncertainty a week, 2 weeks, 5 months out. It's hard to decide how long you're going to commit that capital, right? So it's tough. Something new can crop up every single day, it seems like. All right, and we're just going to wait here. Appreciate everybody being in the joining us today. We got a lot of great stuff. We are going to talk about fund flows. We're going to talk about anything that could possibly really just shake this bear market funk, right? I'm not talking 100, 200 point rally and coming right back down, but something that can, is there anything that can send us back on an upward trajectory? And, I'm really looking forward to somebody talking me out of not worrying about whether or not Russia and China is really a big deal. So it's easy to be Pollyannish about that stuff, and it's easy to dismiss evidence, but it's also sometimes easy to get caught up in the wrong perspective. So I'm really looking forward to talking about that. Why don't we get so we're a couple minutes in here. I think Laura, should we get started? Jack is going to get it here in just a second.
Yeah, it looks like he's logging out and logging back in, so hopefully we'll get him going.
Okay, we'll wait just another moment here too. Yeah, so Celeste, how are you?
I'm doing really well, doing great. It's a beautiful day. And like Tom said, there's always opportunity. You just look for it and find it. Mm-hmm. And, it's great to have knowledge and tools, right? And that's what you all guys do a great job of sharing with everyone, and hope to enlighten everybody here today as well.
Yeah, no, that's great. All right. Well, why don't we get started? Jack will be on in just a second. I'm sure it can pick up. So, I shared my screen and this is from Yardini Research. They update institutional money flows or just flows into mutual funds and ETFs and that sort of thing. And there's several ways of breaking it down between bonds and international. But this right here is all equities, international and domestic. And you can see here it's funds flow. So it doesn't matter where it's coming. It's money going in, net flows into mutual funds, net flows into ETFs, right? And going back to 2013, we can see here the trajectory, and below this line is net outflows, right? And so we peaked towards the end of 2021, right when the market turned, and now we're headed decidedly back on a downward bias. This is a headwind. What do you guys think? How hard is it for the market to rally in the face of this? How big a factor are we just dipping below the line and heading back up? What do you guys think about these, what you see in terms of flows and the impact on the market?
I guess I could start.
Yeah, go ahead, Tom.
Yeah, I think this year, if you look at last year, I look at things sort of in cycles. If you look at last year, we pretty much fell off a cliff all the way to the October lows. Then we rallied a little bit. And then in December, we came down again. And then we started this year. It's like a mirror from January a year ago. This year's January is very strong, where January a year ago, it was very easy to see the market was topped and was coming down. I think, and I told people, I said, I think we could get up 10%. Well, we got up 10% in the first, 40 days of the year, and now we're correcting back. The difference being, I think March is it's going to be interesting. I think the market will maybe climb back up a little bit, but I'm not looking for any, fireworks the first half. Here's what people's got to be worried about. If we do have what I call a mirror year, reverse of last year, last July, we took off for a nice 45, 50-day rally. This July, I'd be looking around July 4th for maybe a reversal of where we're at and head down. And then I think there's going to be some new lows created. Somewhere around 3,200 on the S&P is a good number. Yeah. And that might fit your chart there, because if you look over there on your chart, back over there where that low was created, and then it's
This low is back in early 2021. So this
No,
is
I'd
just
go
all
back to
all
that
of
other
last year
low.
right
See
now.
that low
Yeah.
over there in 16, that low in 16, it looks like.
2016.
Yeah,
Yeah.
26. I think we'll come down at least that far, and it'll be maybe by the end of the year, if we do get that, what I'm talking about, then you'll start maybe reversing back up then, maybe by the end of the year. That's what I'm thinking anyway.
So you think like maybe by the end of the year, investors will start coming back in?
Yeah, by
start
the end of the year, I
contributing.
think, and here they're going to have hope because, you know, you got to look at things, and you got to say to yourself, okay, we're credit card debt right now is like at 70%, highest it's been in 20 years.
Mhm.
New car or old car or used car delinquencies are at the highest rate they've been, I think, in 3 or 4 years. I think the economy right now is suffering from inflation. And so you got to have a little demand destruction, I think, in some of the things to level things that, maybe a little bit lower. Because we really, that big jump we had was caused because everybody was at home and had more money because the government pumped a lot of money into the system, right?
Well,
So,
that's right. Yeah, there was a lot of people had a lot of cash, and some of them invested it. Right, it kind of drove equities, it drove investment
right.
in mutual funds and ETFs and that sort of thing. Yeah. So this is
But here's a factor to shock you to your core. Berkshire Hathaway. Everybody always talks about Berkshire Hathaway. The price of Berkshire Hathaway, if you go back 3 months, 6 months, 12 months, even 5 years, it's right there at that price. So there really hasn't been any growth in that company, Berkshire Hathaway. And so that tells me that we're sort of stagnant, when you see it. Because that's
what do you think, Celeste?
Well, yeah, I think I was so glad that you brought that indicator to our attention, Don, because I hadn't looked at that in a long while. But I think if you just look at the history of that whole mutual fund, fund flow of that, and you go back to the dates, 2013, through to now, and even, back beyond that as well, you see those falls in the market really follow those funds. And that makes a lot of sense. So you get prepared for what's coming ahead, and you have that history as an indicator to tell you. When you look into the future, when I've looked into it for 2023, I see seasonally a lot of up and down in the summertime. So kind of piggybacking on what Tom was saying too, even that July 4th date or just that time frame, I think that a lot of people are about to get shaken up with things going on. And I think that what you brought here is a really good indicator for that. One thing that I've noticed that kind of confirms what we're starting to see here as well is one thing that I watch a lot is this professional accumulation. And I've seen these professional accumulators here in the last month. These plays have really not played out. And it's been, at first look, it looks a little confusing. But when you go underneath what's really happening in the market, things like this, I mean, it really prepares you. And I'm excited to be able to have this knowledge up front, because again, it just helps me be prepared to take advantage of the opportunities, the ups and downs, maybe tweak some strategies, option type plays, whatever needs to be done. Because as short-term traders, we love this type of movement and being able to jump around and make money different ways in the market. So I think, that going into 2023, that the thing is still key, being a stock picker, but also being this master of a variety of strategies.
Yeah, this is one of many indicators of sentiment, right? And nothing rarely ever happens in the summer as far as like a big move, at least in terms of rallies, right? So if you've got a weak sentiment, weak environment, like Tom was saying, that could kind of really get us to new lows. And in terms of equity valuations and that sort of thing, the S&P definitely needs to go down to 3,200, much below that, in order to kind of get us through this trough. But that's going to be a process that I think takes some time, but it'll probably be underway by the summer. That's great. Do we got Jack back yet or not? Doesn't look like it.
Jack.
Hey, Jack. There he is. Awesome.
Hey, Jack.
So what do you think, man? So this is mutual fund flows. I'm not too sure when you hop back on, but mutual fund investor net flows into mutual funds and ETFs, equity-oriented mutual funds and ETFs, right? So as of the end of last year, that turned negative. So people are now net withdrawing capital from those. What do you think this kind of says about sentiment, the direction? How much of a determining factor is this in terms of all the other things that markets have to digest?
I think investors are realizing that mutual funds suck.
Okay.
You've got the
Just
high,
buying stocks on their own. Okay. Yeah.
got too much diversification. This is a stock picker's market. Not everything is going up, and these mutual funds are overly diversified. So you just
100%.
turn your money over to them. It's not even your money anymore. It's their money. And the fees are high, and they've got a bunch of crap in there. And I think people are just waking up and taking action and saying, "Hey, I'm not going to put up with this. Watching my account go down 25 grand every month." So
Yeah.
they're not the only ones. I was reading this information that Lance brought up that showed about the Wall Street firms pulled about 1.5 trillion out of the market. They're in the highest cash position Goldman has ever been in the history of the company. They got more
Yeah.
cash on hand than they've ever had. Morgan Stanley's not far behind them, and neither is JP Morgan, highest in 10 years. So the public's getting out. They've had enough, and Wall Street is chasing these shorter term option durations. So the overall stock market looks like it's going down to me. Very weak.
It's funny you talk about like advisors and mutual funds. So probably 10 years ago now, I started up CEO as an advisory firm here in Baltimore. And so, that's all they do is they talk diversification, right? But technically, here's what they fail to understand. After about 30 or 40 stocks, there's no more benefit to diversification, right? The math behind diversification indicates, and that's the only justification for it, that beyond 30, 40 stocks, as long as they're somewhat, they're diverse themselves, not like rail stocks or something like that, you've kind of maxed out on diversification. Well, if you put 10 mutual funds in an investor's portfolio, in your client's portfolio, all of them holding 100, 200 stocks, right? You're not adding any value. You are just a closet indexer, way over diversified, and there's no chance for you to add any value.
No, but the mutual fund's going to make money. They're going to make money no matter what. It's just a conflict of interest. People are better off, especially in this day and age. Back in the Peter Lynch or whatever that guy's name was back in the day when mutual funds were hot, it made sense because people didn't have all the information that a guy running a fund had. But now, you don't need these guys. It's a stock picker's market. Diversification is a joke. Most things we look at are broken, like the VIX. Just find a strategy. Strategy selection is more important than stock selection, but we're definitely in a stock picker's market.
100%. I agree there. What do you think? So just on that, in terms of stock pickers market, and let's just kind of go to the old trope that we all have to rely on. Is it like value or growth, right? So I was reading the article this morning, a pretty interesting one. So, the argument was for value stocks in in an inflationary environment, and, several reasons to think that, inflation's sticking around. That to me, that and the point was that there's very little, as inflation goes up, long-term interest rates are going to start. The 10 and the 30 years haven't really paid as much, especially the 30 years. They haven't paid the price of the Fed's hikes yet, and inflation, right? Everybody assumes inflation is going to die down and those longer-term bonds, but now they're starting to really creep up because people think that inflation is going to be here with us much longer. It's starting to show the case, and so there's kind of this interest rate sensitivity. Stocks and value stocks are much more immune to that. They're less affected by that than growth stocks. I think there's two things I see, and that makes sense to me. And I'm curious what you guys think. Value stocks, this is, they're not going to, if there is a sell-off and if it's driven by inflation, value stocks are a good place to be. And kind of paradoxically, you've got highly indebted companies, right? Now they can inflate away their debt. Their debt isn't as much as, but there's these growth stocks that are really performing that, you rely on earnings that are going to have a hard time with the recession to generate those earnings. So I don't know, what do you guys think about the value growth argument in this environment? What are your thoughts? Tom, why don't you hop in?
Yeah, okay. I was just thinking about it. I was thinking about one of my favorite stocks of all time is a utility stock called XLU. It's got 26 utilities in it,
Yeah.
but it's trying to hit a moving target right now. Within raising the interest rates, like they're doing, the utility stocks are headed down because they're trying to hit a moving target. Well, how high will interest rates be versus value? And so the problem is you get a good dividend, but at the same time, you lose that much in the stock value. So what did you really gain? Okay. So, a push by Wall Street right now, buy dividend stocks, but I'm sitting here thinking maybe a little early to be buying dividend stocks because we got a guy that's the Fed chairman that I don't think he's as bad as Greenspan, but he comes close. He really doesn't, he's too political for being a Fed chairman. He's always trying to please whoever's in office. And that's why he missed the inflation thing. Biggest job he had, he missed it. And now he's going to overcompensate because there's a lag between the interest rates when he raises interest rates. And there's a lag between the effect it has on the economy. And, that's like projecting into the future. And for a guy that's in economics, that's hard for them to do because they live in the past. Okay.
So you think they're going to, you think they've done enough? You think they actually have tamped out inflation at this point, or do you think they need to go more to get there? I mean, ultimately they will go too far, probably.
I've heard arguments both ways.
Yeah.
The problem is not that. The problem is we got debt sinking us, as a country. Yeah. And then the world's probably in the same debt. And that's why I gave you the credit card deal to see what the consumer was. But the problem is the only way to get out of that, you got to grow and you got to have pro-growth policies to get out of it. Well, we're not having pro-growth policies. We're having socialistic policies. Let's take the guy over here working hard, give to the guy who wants to sit home. Well, that gets into a situation. There's only so much money to give away. And then you can't do it anymore. So, it gets into a bigger problem. So I think
absolutely.
So I think, and before I forget, I got the greatest tip on buying a house. Okay. I just thought of it the other day playing golf, and I'll share this with everybody. Okay. Say you're going to buy a house. If you will wait till the day the Fed announces they're raising the interest rate and wait a couple days for it to sift through the system, you can probably go in 15 or 20,000 below what you were going to pay because they go, oh, hell, I better take this offer because these interest rates are going up. Mortgage rates are going higher. I better take it rather than worry about 10 or 15,000. It's a great buying tip for a house. I just thought I'd share it with everybody because I'm always thinking about getting an edge on anything I do. Right. So, but coming back to what you were saying is that I do believe that the market is sort of in a big wide churn. Okay. And it's a hard sell to get me to believe I can buy a stock and hold on to it and make money.
Well, if I can jump in, I think, back to your question about, value or growth, I kind of go back to even what Jack was saying too, with the stock picking and strategy picking. I just, that's where I'm most comfortable, not so much thinking value or growth, but in the short term now and thinking through the summer months, really just about changing up strategies and being able to be really very versatile and to be able to, just move very quickly based on those strategies versus kind of that growth or value or versus, kind of trend following kind of thing. It's very much about being nimble and kind of bringing to the table a lot of the knowledge and strategies that you've used over the even decades back to the table now. That's kind of my view on it.
Yeah, so I think, let me just jump in there. I think Celeste is really hitting a home run right here because, and I think Jack even said that too, stock pickers market, but strategy is probably more important than picking a stock. The strategy you employ has to meet what they're doing to make money. I don't care how good you are, you got to do it.
Yep.
Strategy selection over stock selection. That's been my mantra for over 2 years. And
strategy and cash are king.
Yeah. When it comes to value stocks, I don't even know what that is. I don't know what that is. I don't know what a growth stock is. If you got a growth stock like that is,
I laughed too, Jack, when I heard him say, what's the difference between value and growth? I guess value means it doesn't go down as far as the growth did, or I don't know. the whole
You-
point is it's all about the price.
You got these companies talking about growth, subscriber growth, and they still don't have any earnings. You know what I mean? They don't even have a PE because they don't have any E, and they're talking about growth, growth, growth. That's not going to work, man. You need profits, you know? So I'm not into growth and I'm not into value. I'm just into the strategy that's going to make me cash. And I got to just say, I hope he raises rates so high, and I hope he goes too far, Powell does, because nothing's going to really work bullish until he starts cutting rates. And if he
Right.
gets them up too high, which he will, then we're going to be in such a beautiful position because he's got so much room to lower them. Whereas last year or so, when we're in this zero interest rate environment, he can't do anything because we're already at the bottom. So I kind of think this whole thing might even have been staged, you know, so he can turn it back around, because I don't see all this inflation, and I just don't see it. And I don't believe that the government can come up with a CPI number or a PPI number. I don't believe in the CPI, the PPI, the FBI, just the DUI. That's about the only thing I believe in.
Hey,
That's what I'm trying to avoid.
hey,
All right.
one of our students here said, why not invest in T-bills and take the 5% return? That's my policy. That's what I've been telling everybody to do.
Hey.
Put your money in T-bills and then be tactical with the extra to trade with. Get 5%.
Get
Good.
this.
Smart guy right there.
I buy T-bills every month, and
Yep.
I read a thing where the government is going to make the offering smaller because they're reaching this fake debt ceiling, right? So I mean, imagine a run on T-bills because
Yeah.
the auction amount is going to be less. I mean, we're in the craziest times I've ever seen.
Well, that's, certainly keeping cash or cash and T-bills and nimbleness is what I'm hearing across the board here, right? And that's, you just really got to pick your spots. I think the other thing I wanted to talk about, but I think I know the answer, is there anything at all conceivable to kind of shake this bear market funk, right? We're talking the Fed's going higher for longer on interest rates, right? But what about getting, that we had 15 years of beautiful upward trending markets, or 13 years of, straight up markets with a couple hiccups, right? Is there anything in the near term that can possibly set us back on that trajectory?
What do you consider?
It could be the Fed turning around and pivoting, right? It could be the Fed turning around and going back to business as usual. But what do you think?
Don, let me ask you a question. What do you define near term? Today, next week?
Oh, let's say over the next 3 weeks, right? Or 3 months. Is there anything over the next 3 to 6 months that is going to turn this market around and give it an elevated direction?
You're talking about a sustained move, like the 12.5-year bull market we had from 75 to 87, like the 12.5-year bull market we had from 87 to 2000, like the 12.5-year bull market we had from 2010 to 22. No.
Yes. Yeah, great. All right. I figured that was going to be the answer.
Yeah.
Jack, Celeste, anything you there to add?
I just got to piggyback again, what Jack said. Yeah, if the Fed would just really raise rates like crazy, in the next couple of days or whatever, and then start to pull back. But it really is going to take that. It's just, there's too much weight on the other side to be able to pull through it really quickly in the short term.
Right. Yeah. So to me, that spells, now is not the time to like adding a tremendous amount to positions, trying to think you're getting stocks on the cheap. Now is not the time to go all in back into the market. You better wait. Wait for the rise. Okay, that's good. All right, last one. Last thing I wanted to chat about here, and then we'll move on to the next thing is, it is not crazy to think. Now we'll talk about Russia and China and the geopolitical situation and the tempo that's setting right here, right? So it looks more than likely like we actually blew up the Nord Stream pipeline, right? That we had U.S. committed sabotage on Russia, right there. That is not certain, but it is a possibility that we need to entertain, right? We're sending tanks to Russia, major equipment. China is now evidently looking to back Russia, right? This makes me very, I guess today's theme is all reasons not to go long. Right? So maybe that's the meta theme here, but here's just another one, why you better, stay light and trade your way through this. but I'm really looking. So, I discount that. I don't discount that very much. I put a lot of credibility, or that's a realistic risk in my mind, right? A very legitimate one. But, it does, Celeste, Tom, Jack, who can talk me back from that? Who can give me something to say, no, it's done. You're thinking too hard about it. Let's move on and just don't worry about it.
Well, not me, because, I think one thing is interesting to me. I think y'all probably noticed we're hearing a lot of headlines on China, the FBI says that COVID, leaked from the China lab. Oh, there are a lot of headlines and to that. And I listen to people quite a bit. And one thing I take note of is like when my neighbor starts sending me all of these news articles about just that with China, and then I open them up, and then I see the bigger headline right here, is that it's like the US is preparing us, I think, for that turmoil that's about to begin, because inside that same article that she sent me this morning, it says, the US is confident that China is considering providing lethal equipment to Russia, CIA director says. So it's like they're preparing us for it. So, I know we've had some training on that, and so I think we've got to be on our toes and nimble, but not fearful because of opportunity. And that's what we're thankful for as being traders.
Absolutely. But and that's, you got to really take advantage of those opportunities is know what condition what context we're in, right? What's the overall environment that everything else is taking place in? It's easy to forget those. Jack, Tom, you guys got anything you want to add to that?
I think China's going to take Taiwan at some point. They're going to try to do it maybe peacefully. The U.S. said they would defend Taiwan, but they're gonna give Russia the weaponry to see how well it works, and consider whether they're going to do it themselves or not. But this whole chips thing is going to be a real driving force, and China wants that stuff. They're going to get it one way or another. So
yeah.
And I wouldn't worry about it. We've been talking a lot about what reasons why we shouldn't go into the market, but we got to embrace this market. We always got to fight the fight we're fighting, so there's plenty of opportunity in this market. And there's going to be plenty of opportunity if some kind of war breaks out or stops, because there's always an overreaction to that news and that event. And I'm more of a guy that likes to react rather than predict. So it doesn't matter to me what they do. I'm ready.
Yeah, and that's the key distinction, right? It's not saying just put all your money on the sidelines and sit there, right? It's you got to move, you got to act, right? But and knowing what that long-term direction is, right? The overall tempo is an important part. Tom, you got anything to throw in there?
Yeah, I would say that everybody's got opinions about this or that, but the bottom line, follow the numbers. They'll tell you. Like today, if you're looking at interest rates today, the bonds, which were bouncing, the long bond was bouncing, now is making lows. So what is that telling you? It's telling you about to crank interest rates a little higher in the market before the Fed does its thing. So I think you just got to follow the numbers. Like Apple. Everybody loves Apple. I love Apple. I've been buying it since it's $7 a share, right? Well, I'm short Apple right now. Why am I short Apple? Because it's going down. It's pretty simple.
Mm-hmm.
If I can just jump back in real quick too on that, something that listening to what's going on around, because I think America is very resilient. And we saw during the COVID, I personally saw a lot of people leaving different industries and starting companies, big companies here in the US on our soil to bring back that manufacturing. And that's so key. I think that might be someplace down the road where there's some opportunity. So again, never to be fearful, always up and down opportunities.
Well, there's certainly bringing in all those supply chains, chips or chip manufacturing is a big part of that. So to the extent that we can get that capital and get that investment, I think that's that's certainly a long-term thing. But really focus on right now is really just hey, are we paying attention to the right things? And unfortunately, there's a lot of things to pay attention to. Hey, Tom. All right, so you got something you want to talk to us about?
Yeah, sure. One of the things that's really working, for us right now and for anybody that listens is earnings. And the thing about earnings, and I did this for years, I always tried to say, well, the earnings are going to be good, they're going to be bad, the stock's going to go up, it's going to go down on earnings. But what we developed is sort of something very unique, okay, which is an approach to earnings. I call it earnings afterburner. Now, I say that thinking everybody knows what I mean by the word afterburner, okay? And I found out a lot of young people don't know what an afterburner is. But if you've ever been to an air show and you see those jets take off and you see that fire coming out of the engines or the tailpipes, that's an afterburner. That's when they really go into high gear. And so what I've found and what our research shows is that if you don't worry about the earnings, but worry about the reaction to earnings and frame it, there's a lot of money here. And I mean, I'm talking about for really, really some risk rewards that's pretty low. Classic case, Target came out yesterday with the earnings. It went up to, in the pre-market, to 175. In the day market, it went up to 172. It started breaking down. And I told people yesterday during our training session, I said, I think it's going to go to 162. And I got an alert and I said, look at Target. It's headed to 162. It's 164. So that's a earnings that everybody was hyped on. And all of a sudden it's starting to, the afterburner effect taking over. So that's an example. Watching earnings after the time. And I want to thank everybody for being here, but we put together something that's pretty neat. It's a special opportunity if you want, that we want to share with you. It's very brief and to the point. We call it the afterburn status of a stock after they report earnings. And you go to Nasdaq.com and find out what's the hottest candy on the market today or the weakest candy on the market, and watch it. You'll see what I'm talking about. But these can be traded with options after they occur, and it defines stocks. And we got a framing technique that we teach. And for the next 3 days, those stocks will go in that direction when they break that frame after earning. And it's pretty cool. You don't predict anything like Jack says. You basically just reacting to the news and how the market reacts. And you sort of not, you're not thinking, hey, it's got to be up. You're basically thinking the market's telling you it's going down. And you know the direction it's going and you trade in that direction. You wait till that status hits, which is after earnings, and then you take your trade. Now, after our test, it was really unbelievable the percentage of stocks in that movement. It correlated very, very good. Something like 2.7% was the number. And then you take that to an option market, it takes you up to 20-30% by going with leverage. Okay. Pretty good stuff. So the 5-step training guide we put together explains all the guidelines and rules for trading afterburn stocks. And so if you want to join, you can do it for the entire strategy report. By the way, we put this report out this weekend, and I'm getting around the clock, around the world, we're getting sales at $5 to learn this. So go to dtitrader.com/roundtable, get a copy of it. See if it doesn't give you what I call a viewpoint on earnings. And if you've got portfolios, you got to pay attention to this report. Anyway, that's something that we'll throw out there at $5. If anybody wants to get a copy of it, get signed up. And I'll probably have a live meeting associated with this at some point once we hit a certain number. But this is, all these years were wasted because I used to, thought I was Nostradamus trying to predict what they were going to do. A lot easier, just wait till it happens, then do it.
Yeah,
Well, that's exactly the environment we're in, right, Tom? That's what you're saying, is that this is what we've been talking about all day. There's a lot of near-term uncertainty out there, and you can measure near-term in months and quarters, right? So yeah. It's really hard. It's a very volatile situation to sit there and try to make predictions. There's no trajectory that carries on from the past. So see how it reacts, and then right. That follow-on is what you're really taking advantage of. This fits exactly what we've been talking about today.
Well,
exactly.
The interesting part, we actually have an earnings program, but I was looking at it. I mean, like, since we started doing it, we're like 11 for 11. Okay. And I'm looking at that going, that's pretty good accuracy. wonder when the mistake's going to come. So it's almost like, you ever watched Houdini, which time is he not going to get out of the water? So it's sort of fun to follow. We'll see when that happens.
You've got catalyst. I mean, you've got a catalyst around earnings, right? So,
Right.
we're in these kind of doldrums that only really trade around CPI, the Fed, and earnings, right? And so this takes care of one of those catalysts. The only thing that we can think of, we're all scratching our heads looking for 3 weeks on this show. We've been what's going to move this market one way or the other, and nobody can really think of anything, and there isn't anything. And this is what you need something to get things moving. And this.
Here's something, Don, that most people don't know. Most people say you have earnings in April, you have earnings in July. You got earnings every month. I mean, there's so many companies out there reporting the opportunities every week, every day. You got like Costco's this week. That's one, to look at.
Yeah, there's a bulk, but still there's always reporting throughout the quarter. That's right. Yeah. Yeah, well, this is great. What a great price. You got to hop in on this.
It's a great thing. There's always a strategy. We just got done talking about strategy selection as a way to make it through some tough times. And Tom's got a great strategy right here for you for $5. Everybody should buy this. It's a screaming deal.
Jump in on it. And I guess Celeste had to leave. Sorry to see her go. She had to run. She's got had to appointment. She couldn't move. Well, yeah, Tom, appreciate it. So everybody, I'd encourage you to get get this report. I think I really enjoyed the session today, guys. It was kind of gloomy topics, I guess, but hey, that my whole point is, don't ignore what the environment's going around, right?
I got one thing to say, Don. It's not gloomy if you're making money. You don't care which way it goes. Just change the strategy. Hey,
that's right.
I can be happy with it going down or going up, and Jack can too.
I'm happy with it going sideways. It really doesn't matter to me. I'm selling premium.
Right.
That's never going away. And the market goes up.
100%. That's precisely my point in trying to talk about these things so people can really focus on what they can do each day. And there's it's a stock picker's market. You gotta really react to the information because it's impossible to predict right now. So being nimble, being able to move and get on the right direction and let the winners run is key to that. And this report will help you do it. So everybody jump in there, get it.
Everybody have a great day. Tonight I'll be back at 8 to do a weekly planning if you want to come. But thank you for being here, and thank you, Don. Great show.
Thank you, Don.
Awesome. Yeah, appreciate you guys. Appreciate you being here. And thank you everybody for joining. We'll see you next week.
Good seeing you, T-Bone.
See ya.
I take care.